Folks, welcome back to the Taylor Tax Show, the show where we help highly paid, highly taxed, high profile, and a new one, high net worth or ultra high net worth taxpayers save a bunch on their taxes. I'm Terrence Taylor, the co founder of Taylor Tax. This is Big Al Donnell Jr., co founder of Taylor Tax. So, what's up, Big Al?
What's going on, everybody?
All right. Today, we're talking about something that we hadn't even planned on talking about until the news came out that Antonio Brown is broke. He's filed for bankruptcy. Big Al, it really pains me when I see athletes who make tens of millions of dollars go broke. And today we've decided to explore for educational purposes, folks, what likely happened with Antonio Brown in terms of tax planning, and more importantly, what are the options that are available to him now that he's filed for bankruptcy. And Big Al, don't quote me on this, but I remember can I say this? Alex Rodriguez, A-Rod, on the Grant Cardone, what is it called?
Yeah,
Not even YouTube channel. It has this conference, which is like
the 10X
conference.
conference. Yeah, the 10X
Yeah,
conference. Yeah.
yeah. So Alex was one of the billionaires that Grant featured, and I was shocked when he said something to the effect of athletes go broke a lot of the time. I think he quoted something ridiculous like 90% of athletes end up broke.
Wow.
So when
Wow.
Big Al and I heard the story about Antonio Brown, it just really forced us to look at what really happened and to think about how can we educate folks who are highly paid and high profile, like athletes, about tax affairs so they know what to take to their tax strategist. If they have one, they all should. And they can ask the right questions and get into the right situations where those tens of millions of dollars that they've made leads them to a life of sustainable wealth as opposed to going broke. So I've said a lot. I want to hand over to Big Al to kick us off. Big Al, tell us a little bit about what happened with Antonio Brown. Like, what do we know from public sources?
Well, yeah. So from my meager research, the current situation he's in is number one. He brought in over $88 million over his 12-year NFL
Wow.
career. All right. And we both know that a large portion of that, possibly 50% or more, went towards taxes.
Mm-hmm.
Then another strong portion went towards his agents and managers as well. However, that still leaves him with $35 million over his career. Next, he filed for Chapter 11 bankruptcy. All right. And Chapter 11 bankruptcy is the one where you restructure your affairs and get on a payment plan, and the courts pretty much dismiss all of your creditors' advances or communicate towards you in order to repay you to repay them. So that's the Chapter 11 bankruptcy that he filed. Now, since he's a resident of Florida, which is pretty important, Florida has a special law where if you own your house for over 1,200 days or 1,215 or 16 days, then it can't be included. Your primary residence can't be included in your bankruptcy proceedings. So from what we understand, he purchased a $6.6 million home in Florida several years back, which is alleged to be worth $9 to $10 million today. Next, he was sued by several entities. They say that he owes $3 million, which brought on his request for a bankruptcy. Much of this is due to lawsuits that he's obtained for failure to appear at a Rolling Loud concert or monies owed to other entities and so forth. Then finally, he claims to only have $50,000 in assets to his name, of course, outside of his house. Now, we also know from, the public domain in times past that he has had several endorsement deals. He's had businesses, nonprofits, real estate holdings, and the such over time. However, based on what the court proceedings show, which are usually pretty thorough, you know, uh, they state that he only has $50,000 to his name. So I'm not sure how those other partnerships and deals, came about or what happened with them. But that's the case now. So we can't quite say that he didn't use any tax advice or he didn't use any advice at all. However, all we can go off of currently is what has just been reported in the news about this bankruptcy, $50,000 assets to his name, and him owing $3 million with a close to $10 million home. So what we wanted to do with this podcast, and this is one, Antonio, if you're listening to this, it's all love. We're just using this as a cautionary tale and an educational opportunity for other professionals, sports professionals, high income, high profile professionals, just to learn the basics, an outline of what we would do and what we would advise in a situation where you are in a beautiful, amazing, taking advantage of an amazing opportunity of making tens of millions of dollars a year, and how to hold most of it. Because as I said earlier, $88 million in income, more than likely close to 50% or more of that already going to the IRS, which if you were to talk to a tax strategist or someone like Terrence and I, which are both enrolled agents, we could have made it so that you wouldn't even pay close to the 50%, probably more like 20%. Or less. So anyways, I want to throw it back to you to start us off, because how we want to structure this podcast is we just told you the current situation. And now we want to break down the advice that we would have given him had we around when he got that first deal for like $42 million over 5 years, and how we would have given them insight in certain tax strategies, which we believe should be at the forefront of these windfalls of income from the start. And then again, from right now that, everybody could say general advice to anyone else.
Yeah. So on my side, you went out for about 30 seconds. I'm not sure if that was on the recording. So back
Yeah,
up.
that's a good point,
Yeah.
because I'm seeing it.
So,
It stopped on my side and then it started back now. What time do you show on
yeah.
yours?
So I show 8:29 in the podcast. So do us a favor, just go back about a minute and just repeat some of what you said in the last minute, just so we
Okay,
capture it.
no problem.
Mm,
So how we're going to structure this particular podcast
mhm,
is I just told you the current situation. And
mhm,
what we're going to do is Terrence and I are going to break down what we would suggest as tax advisors
mhm,
to Antonio Brown had he known about us and engaged us to be his
mhm.
tax strategists and tax advisors from the beginning, the start of his career, when he got that $42 million 5-year deal, I believe, with the Buccaneers, and so
The
forth, so that
Steelers,
he
I think.
the Steelers are thank you, so
Yeah.
that he wouldn't end up in the situation that he's in now.
Mhm,
And then also we're going to break it down from what we would suggest currently with where
yeah.
he's at, because we all could say hindsight is 2020, and
Yeah.
what we should have, what you should have done and how we would have done things. But
Mhm,
moving forward now, what would we suggest he do? And then
yeah.
also general advice for anyone that's this current situation.
Yeah.
But once again, all love to Antonio Brown. But yeah, so talk to me,
All love.
Terrence.
All love. Hey, Antonio, if you are listening, this is love. And everyone else who's listening, this is for education, right? So we weren't Antonio's tax advisors. We prayed that he had tax advisors. Given what we're seeing, we suspect he may not have. So let's go. Let's get it. Um, all folks who find themselves as highly paid, high profile, therefore you're going to be highly taxed. And Antonio's case, definitely it was high net worth because of the amount of earnings he got. So he ticks all the boxes of folks we're trying to talk to. So 7 things we would recommend. I'm going to go through them relatively quickly because this is for education, and we would advise anyone who's interested in any of those 7 things or all of them, get in touch with tax advisors. Of course, we're always happy if you get in touch with us. Terrence at taylortax.ai, Big Al at taylortax.ai. That's how you can reach us. But Big Al, first thing I would have suggested, and I'm sure you agree with this, is Antonio, put yourself together a team of advisors. And top of that list, get yourself tax advisors and strategists. And then make sure that you also have tax accountants who are excellent at bookkeeping on that team. Make sure you have attorneys who are sports attorneys and also entertainment attorneys. If you can find someone who can do both, fantastic. Why? Because you're going to get the endorsement deals that you did, and you want to make sure that your contracts with those folks who are paying you to endorse their products is tight. And of course, you want to make sure that your contract with the teams you play for is tight. Then you also need to make sure you have on that team excellent insurance agents or professionals. And we'll talk about why in a minute. And perhaps last but not least, you want to make sure you have a business manager who's on top of everything that's going on for you, because you're going to have a lot going on. Okay, so that's step number 1, Big Al. Step number 2 begins that 6 levers that we told folks about in podcasts already. So Antonio, we heard you did this, and we would advise you to have done it maybe a little bit differently. Start your own business. Now, you started businesses, which is fantastic, but start a business where you incorporate, as Antonio Brown Incorporated, for example, and you are the professional that brings in the income for Antonio Brown Incorporated. Why? Because then all of those places you went to play football becomes business expenses because it's business travel. So your tickets, your accommodation, any transportation, even meals, when you structure them properly, can be written off as business expenses. So you to save more of your money that way. But even more importantly, with an insurance agent or professional on your team, you could have actually taken out keyman insurance on yourself on behalf of that business. And based on what you earned, keyman insurance may have actually even protected between 10 to 50 million of what you were earning, right? So that's the business angle. And of course, all the businesses you started, if you had really good bookkeeper and tax strategists, they could have helped you to figure out how to maximize your tax savings through the business legally. Big Al number 3, make sure you invest in real estate, which it sounds like you did. We're curious to know, though, what kind of real estate investments you had, because we would have advised you to invest in real estate that is rental real estate. And we heard that you had some commercial real estate investment, which does sound good. But the way we would have structured it for you is, hey, get something where you can rent it out and you can qualify for something like the short-term rental exclusion, where you have to rent it out like an Airbnb type scenario where you're renting it out 7 days or less to different renters during the year. And that allows you to qualify to make any income and losses from that business active. And that helps you to reduce the tens of millions that you're making from football, which was being taxed. We're pretty sure at pretty high rates. Helps you to lower that tax. Fourth, Big Al, we would have said, Antonio, get yourself that insurance agent to look strategically at what other insurance is available to you. So, for example, you could have taken out an indexed universal life policy that allowed you to set yourself up in a way where that IUL could, for example, start off with you qualifying medically for it and being able to put 2 million a year into it. And if you did that for 5 years, it would fully qualify as an insurance policy. You would have 10 million working in the insurance policy, and with the compounding and the indexing feature, that 10 million every 5 years is growing so rapidly, Antonio, that by the time, let's assume you started this when you were 21. By the time you got to 76, do you know if it was a 6% rate of return or interest on that index universal life policy and the cash value and death benefit amounts, you would have a policy that potentially could be worth 4.2 billion. Now, Big Al, I was amazed when I looked at those numbers. Right.
Crazy.
So,
Crazy money.
yeah, right. And then the fourth thing we would have advised you is to immediately do an estate plan, where we would advise you to have structured yourself in a way where you have a revocable trust, where you put all your assets that you want to be subject to estate taxes, and you put together an irrevocable trust which you set up to fund to be able to pay your estate tax. And again, this is where index universal life policies shine through, because in your irrevocable trust, an index universal life policy would have allowed you to have a policy that has enough cash value for you to pay your estate plan. And because of the feature of being able to do policy loans, you could have taken out a policy loan to pay the estate tax and still have that money working for you. Right? So Big Al, that's number four, I believe, number five, right? Number six, strategic gift giving. Our understanding is that you have a foundation and you help out in the community, which is fantastic. We would have loved to have sat with you to figure out very creative ways for you to do the strategic gift giving that are tax advantaged. I'm not sure you did this. Maybe you did. We don't have the details, but opening a personal family foundation, the Antonio Brown Family Foundation, for example, or the Brown Family Foundation, would have allowed you to do amazing things in the community and also potentially employ people both in your family and the extended family to do things in the Personal Family Foundation, the PFF, while paying them to do so and making sure that 5% of what you have in the PFF is going towards a 501c3. And some of the family's travel to do the charitable things that you're doing in the community would have been things that the PFF could have picked up. You wouldn't have to come out of pocket for that. And then Big Al, number 7 now, I think. I'm losing count. Number 6, so. No, number 7, yes. Number 7 would be, we would have said, Antonio, you're going to make a lot of money. Set up a private equity fund and begin to invest in startups. And because you have set it up, you would be treated as a manager of that private equity fund and the general partner in that fund. And therefore, the gains that the fund is likely to get would be subject to the carry, which allows you then to pay no more than 20% taxes on that. So Big Al, I said a lot. I tried to keep it as short as possible, but that's how I would have advised Antonio to start.
No, I
So
think
let
it's
me hand.
phenomenal. Yeah. So the
Yeah.
that structure that you mentioned, yeah, starting a business, investing in real estate, making sure that you're tight on insurance, strategic
Yep.
gift giving, retirement planning,
Mm.
estate planning. And I'll say this because what we're dealing with in this situation, dealing with a deca millionaire, meaning like he's got tens
Yeah.
of millions of dollars. And with that, you're going to have to get into the area of estate planning, of
Yeah.
high levels of insurance and insurance planning
Yeah.
inside of your
Yeah.
estate and your tax plan. Also
Yes.
think about this, holding companies. All right.
Mm.
You can have a holding company that holds several assets of yours, especially the real estate assets and any other assets from your other businesses, and keep that separate from your operating so that with a holding company, it's non-operational, so it can't be sued. And then when you have these separate tax structures, when you, as Antonio Brown, are being sued, your company, which is a completely separate entity, individual, those still retain their assets, still retain control over the assets. And I'm pretty sure most of you all have heard this before. Would you rather be a billionaire? Or would you rather have control over $1 billion. The key is to have control over the $1 billion, because once you're a billionaire, then the target is on your back. So, which unfortunately could be the situation with Antonio, where there's a target on his back due to certain personality traits and his image in the public, so on and so forth. But yet and still, with these separate entities, holding companies, trusts, irrevocable and irrevocable, because I think that was an absolutely genius concept and idea, Terrence, of holding enough in an insurance policy and in an irrevocable trust, which is separate from your estate, to pay for the taxes in the revocable trust, which holds the assets that you want to pass down to your heirs. Because from what I understand, you got children just like Terrence and I do. So anyways, I think those are all great suggestions, and that's what we would advise for our other situation. Did you want to say something else?
Yeah, I wanted to come back in because I realized, and that's why I was tripping up on the numbers. I realized I actually missed retirement planning for Antonio.
Okay.
So let me go back. That, folks, that would have been number 6. So number 7 would be private equity. Number 6, Antonio, with retirement planning, it would have been such a pleasure to have advised you to start retirement planning right away. So most of us, when we have employment situation, we have 401k. I believe the NFL does have its own pension plan. And on top of that, we would advise you to get that insurance specialist and professional in to structure, again, using things like the Index Universal Life, a retirement a policy for your retirement. Why? Because unlike the pensions and unlike the 401ks, when you have retirement planning via an Index Universal Life policy, you're able to structure it so you decide when you take out the funds, you decide how much you take out, and it's advisable that you only take out retirement funds through policy loans, which the Index Universal Life allows you to take up to 90% of the value, the cash value in the policy. So we would have advised you to do that, because that is such a compelling structure for everyone who want to do retirement planning, and especially for those who have tens of millions. All right, Big Al, let me hand over to you. Let's look at, given where Antonio is now, what are the options that are available?
Well, yeah. So yeah, we can all say the hindsight's 2020. What we should have, could have, and everything that should have been done. But the past is the past. Where we are is where we are. How would we move if we were to retain our services now? If we were to give him professional advice right now? This is once again from educational purposes to those that are listening, and there's more nuance to it. But in general, what we would suggest, there's a couple of options, 2 to 3 options. Number one, a clear option is, if you got a home worth $10 million, and let's just say your mortgage is $4 or $5 million because it was $6.6 million when you got it, you had to put, let's say, 20% or more down, then sell the home. You got to pay capital gains taxes, of course, with the Section 121 primary residence exclusion on $250,000, because from what I understand, you were unmarried. He's unmarried. So nonetheless, sell the home. You have enough money to pay off pay the taxes on the gains, pay out of the bankruptcy, so you could be completely done with the Chapter 11 bankruptcy, and then you would still have around $1.8 million left over to kind of restructure your life. And guess how we would suggest restructuring of your life? Everything that Terrence said before, those 6 steps: starting a business, buying real estate, investing in insurance, gift giving, retirement planning, estate planning, and private equity. Now, the thing is we understand that there's a lifestyle that you're accustomed to. However, that lifestyle doesn't include bankruptcy. So that lifestyle can also be something that is better above bankruptcy, which might still be lower than the rock star lifestyle that may have been led before then. So in that situation, just like Terrence said, we would highly suggest starting a business where you're incorporating yourself. Just like Jay-Z was saying, I'm not a businessman, I'm a business man.
Business. Yeah.
So you're incorporating yourself in everything that you're doing, which then allows you to separate the entity from the individual. So if somebody sues the individual, the entity still has control and access resources. And then also, we would suggest that you invest in income producing investment properties, rental or
Mm-hmm.
real estate,
Mm-hmm.
and not just all of the money in one primary residence. Uh, and with the insurance policy, we would definitely suggest the bulk of that 1.8 million left over go into a IUL, a life insurance policy that allows you to fund it, overfund it at the beginning, so that you can use policy loans to live off of in the future, which then helps you create a tax-free life altogether. And that's just one, I guess, one aspect or one leg of the whole plan. But still, that would be phenomenal. So that's what we would suggest from a right now point. So now, giving general advice to anyone that's in the professional sports field, what we would suggest is everything that we suggested to Antonio in this situation. Once again, go through those 6 steps, and then make sure that you consult with a tax strategist, a tax advisor that can help you. Also, for those that believe you're going to get there, but you're not in the draft yet, check out Tax Strategies GPT. We understand that there's a lot of ways now to make money even before you get in the league with NIL, name, image, and likeness deals, uh, where you can become a business once again even before you're a pro. And I actually have clients with NIL deals, high school students, and those that are just college students, and those that have just graduated college that still have some of those deals where it's benefiting them profusely. So that's what we would suggest. Any last thoughts from you, Terrence, on general advice for anybody other in the high profile
Oh yeah, sure.
players?
For sure, Big Al. And again, folks, we're educating here. Please do consult with tax professionals like us if you want to follow this advice. So, Big Al, when we looked at Antonio's situation, we said that 2 other options he could possibly do. So
That's right.
let's be real. Most likely, he wants to do nothing, and that's always an option, right? You could do nothing. Here is the difficulty, though, based on what is emerged from the filing, or at least what's been reported about the filing for the bankruptcy. With 50,000 in assets and a home that's worth between 9 and 10 million, and apparently the bankruptcy shows that there's no income, no current income coming in, doing nothing is not going to be sustainable, right? That 50K is going to go very quickly. And as much as the mansion must be stunning in Florida, 10 million, are you kidding? It must be glorious. You can't eat the mansion, right? So doing nothing is not sustainable. So we would not even, well, we definitely wouldn't advise it. We would talk through to make sure that any client of ours who's thinking that way comes to Jesus sooner rather than later, right?
All day, all day.
Right. Now, the third option is, all right, look, we've already talked about selling the home, but you may say, like, well, actually, I don't want to sell my home. And we get it, right? What if you are able to look at what the mortgage is currently on your home? And if you haven't already done so, you can take out a home equity line of credit, a HELOC. Now, most banks are willing to give a HELOC up to 90%. A lot of banks are willing to give a HELOC, and some are willing to give a HELOC up to 90% of the value of the home. So potentially, depending on how much mortgage debt you have on the home, I'm going to use Big Al's example of you had 5 million, right? The assumption of 5 million. You take out a HELOC that gives you up to 9 million. And I'm going to be conservative and say the HELOC only gave you 7.5 million. That's still, the HELOC value, the HELOC decided to give you a loan that's based on 7.5 million. So what they would do is say, okay, you got 5 million, we would have given you 7.5 if there was no mortgage debt on it. So we're going to give you 2.5 million. So that's 2.5 million to then do what Big Al talked about in scenario 1, in option 1. Again, go through starting a business, but incorporating yourself as the business and any endorsement deals that you may still have, any image royalties that you're getting. We understand that you're working with Kanye in music, and there was supposed to be some income based on that. But those types of things, this option three would allow you to say, all right, I got 2.5 million. I'm starting a business. I'm going to incorporate myself. I'm going to do key man insurance. And folks, we don't want to belabor the point, but you can go through all of those 6 steps of starting a business, investing in real estate, making sure that you use insurance strategically, estate planning, strategic gift giving, and private equity. Those will still be available to you, and you get to keep your home. So, Big Al, that's where we landed in terms of options. Let's talk now about general lessons. All right, this is one of, I think this is our longest podcast so far, but we're just so fired up about this topic. So let's bring it home for folks. Like, what are 1 to 3 things that everyone can learn from this? Because again, we did this for educational purposes.
Well, I'll tell you this. I think if I could only choose one thing, my one
Mm-hmm.
thing would be this, is that you need a team. You have to have a team. Like you mentioned before, from starting with the tax strategist, tax advisor, going on with an investment advisor, a business manager, attorneys, whether they're sports management attorneys, business attorneys, entertainment attorneys, an insurance agent, possibly a real estate advisor, and the such. Make sure that you choose a team that is going to serve your best interests, where they're all focused. It's kind of like a family office, if not a
Mm-hmm.
family office. A lot of times you have to have a lot more in net worth in order to hire a family office. But to assemble a team and put a team together in order to make sure that everything's being looked at from a compliance standpoint, from a expense reduction standpoint, from a revenue expansion standpoint, all for your benefit. Because the thing is the end goal is not the end of your professional career, but it's beyond your life
Mm-hmm.
is the end goal, that we should be
Mm-hmm.
striving for. And before you jump in right quick, I just wanted to use it as a segue because our next podcast is talking about some strategic partnerships that we have that will help you assemble this team, this dream
Mm-hmm.
team for yourself, especially at this level of income and this level of net worth. That'll be super beneficial for you. But yeah, go ahead and take us away
Yeah,
there.
yeah. I want to jump in here and say another lesson is be strategic and make sure you get the right advice. So, for example, one of the things we didn't even touch on, Big Al, is in the public domain, Antonio is known to have 6 kids, right?
Yeah.
Again, using insurance strategically, those kids to be millionaires through the $1 million baby strategy. So you take out an index universal life policy on them and you insure them sufficiently that the compound growth in that index universal life policy makes them millionaires in their lifetime. And again, one of the best features of an index universal life policy is the policy loan, which can be up to 90%. They would get that tax free, but that money will still be working for them as if they didn't take any money out. So be strategic will be another one, Big Al.
All day.
Any others from you, or should we wrap it up?
That's it from me.
All right. Folks, thank you so much for listening to this. We certainly want to help highly paid, high profile, and high net worth taxpayers who get this golden opportunity to make money through things like sports, to stay financially stable, and to build on the tens of millions that you have, as opposed to the 90+% that A-Rod said go broke. So thanks again for listening to the Taylor Tax Show. See you soon.
Cheers.